Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, June 15th, 2023. It's 4:37, so we are closed for the day. Markets are closed for the day, that is. And what I'm going to do in this video is cover three things, and most importantly, highlight the correlation between these three things, and those three things being commodities, the stock market, and the currencies, major currencies, US dollar and or the euro, which I'll say euro is basically an inverse of the dollar just due to the weighting in the index. It's the largest component at nearly 60% or so, and so it's going to have the it's going to go up and down inversely with the dollar. But then there is, especially at this point in time, or really since the bear market started, an unmistakable, I showed it to you and I'm going to show it to you again, correlation. And here's the thing about that. Okay, so there are a lot of things that are correlated positively or negatively correlated, meaning, obviously if they're negatively correlated, one goes up, the other goes down. And sometimes it's just due to certain variables, and there's no predictive value in that. You might know there's that negative correlation, but so what I've been looking at the charts, and the big question is that what comes first, the chicken or the egg? And I think there is a identifier here, and that is usually it appears to be in the case of currencies, the currencies turn first, and more so commodities. So let's start out with commodities. Bear with me. I'm talking about now the relationship between commodities and the stock market. If you're new to the site, for the last couple of years, I've been using this as my kind of go-to commodity index or ETF, and there's quite a few out there, but this is one of the more balanced commodity ETFs or ETNs out there. It tracks the Dow Jones, UBS Commodity Index. Over time, the sector weights will change a little bit, but not too much. And what you'll find in all general, broad-based commodity indexes, that means they hold energy, which is natural gas, oil. They'll hold industrial metals, copper, lead, things like that. They'll hold agricultural commodities, both hard and soft commodities, timber. They'll hold, grains. And so that is what a broad-based commodity ETF is. Some are more focused on only the soft commodities or agricultural commodities, metals, etc. And so what you're going to see in just about all of them, energy makes up the biggest weighting. So just keep that in mind when if you are trading a general broad-based commodity ETF, you want to make sure that you have oil and or natural gas. Oil's first and foremost, then natural gas. You want to make sure that they are on the side that you're positioned long or short, because you can have soybeans ripping, but it's not going to offset a big drop in crude oil. So keep that in mind when trading them. Me personally, because at any point in time, just about, other than, we saw a big strong rally where all things due to the hyperinflation, just about all commodities were going up in sync. Other than that, especially during periods of consolidations, corrections, sideways trends, I much prefer to be selective. Long the most bullish and or short the most bearish, or out of those that have what I call indeterminable charts. Sometimes, a lot of times, I'll look at something, I don't have an opinion. Someone will say, "What do you think about XYZ?" Look at the chart. I have no idea. Could go up, could go down. So, for example, livestock, I think, was sucking wind today. And as I said, and I've been highlighting recently, the grains took off. So I'm going to get to all that. And I just kind of want to throw that out there for those of you that want diversification. Maybe towards the end of the video, I'm going to speak to that a little more. Because I just, I always try to keep up with the comments on the site. The threads are getting out of control. There seems to be a couple, few very vocal people that must have just put everything they had in QQQ. I will and always have look for tops and bottoms. Not going to get them all, and so I'm going to keep throwing out objective shorts, whether it's QQQ, SPY, Bitcoin. I heard very little when we shorted Bitcoin and Ethereum at the highs, literally within 1 or 2 points. And it's not like it was a short-term trade. 4 targets were laid out. We shorted one of these days within a couple basis points, but yet So there's a catch a falling knife trade. Sometimes you try to catch a falling knife, and when I say that, you're referring to something that's dropping. Beyond Meat the other day, that was at 52-week all-time or multi-year low. That's a catch a falling knife trade. Sometimes they pan out. Sometimes you get cut. You get some nicks trying to catch that falling knife. You only get gashed if you just don't use stops at all and let it run forever. But a lot of these trades are up a whole lot more than the stock market is down over the same period of time, and they look very similar. Like you look at Bitcoin, by the way, it's still holding on that T3 level. I told you the other day, hit there and probably going to get a reaction. We've done a few 1, 2, 3, 4 days and started to lift. Ethereum actually was down today, and that's all for all intents and purposes. That's T4 close enough. There may be more downside. I'm still holding on to these targets. Told you we'll just probably bounce first. That target T4, the support levels at 7, so you want to cover before that. And before that is relative to how volatile the security is. If it's a very high price, 300-400 point security, you're talking, maybe 20 points above it. If it's a $7 security, you're talking, you're getting down to within maybe a quarter. So the low so far on the ETHE short trade was 714, and you had that's pretty darn close to that $7 level. And like I said, probably see at least some consolidation. It's good support. But again, these are both, swing trades. Just, haven't hit the final target, so they're still active, 32%. And, I'd like them better. They'd be much more objective short entries if we bounced up to T3, maybe even T2. But, and what I wanted to show you here, no, I'm getting off on a tangent. I'm going to get back to commodities. This chart, look at this chart. Does this not look like something here? You have this big drop. You had a big, divergence, positive divergence at the low. Strong case to go long. If I'm not mistaken, we were around that time, been in and out of Bitcoin and Ethereum so many times over the last few years. My head could spin. Non-balance, most of those trades were profitable. By far, actually, did very good on Bitcoin and Ethereum. Just haven't talked about it much lately because it's been kind of slogging down. But what I want to show you is that, what I see is a very similar. I see a primary downtrend line. I know I've got a gazillion things here. Primary bear market downtrend line, which was taken out. You had positive divergence, divergent low, and then you broke out. You consolidated for a while right here, and then you had this near parabolic thrust up. You took out the 200 days and all that, and then that was it. So, there's the same case can be made. Why would you want to short the NASDAQ? Now, this is what the NASDAQ and the S&P look like. When you look at the broad market, you almost have an identical type pattern. You had the primary downtrend line right there in yellow. You broke out above it. Then you consolidated and you did this little rip. This looks like a final stage kind of blow off top to me. And again, all indicators long term. Well, we won't know until we got another 2 weeks before the month closes. And like I said, that'll make a change. So we've got whatever it was yesterday. I told you 4.5%. We have to drop in the S&P to just hold on to those key long-term indicators that have yet to close on a monthly basis to flip from bearish to bullish. All right, let's do this. There are other trades, time permitting. I'll get to some of those trades on the, let me see, pop that back up. But here's what I want to show you today, because we're going to talk now about commodities, the relationship between commodities and stock market, as well as the currencies. And again, try to see if there's some predictive value. All right, so here's the ones that I've highlighted recently. UNG up 8.84, almost 9% today. And so there's a couple things. I got a post out to you today. I'm just going to repeat that. One day doesn't make a trend, but since the FOMC meeting yesterday, here's what we look at. The stock market, and QQQ was up about the same as SPY today. I think they were both up about 1.2%. Yeah, QQQ was 1.2, SPY was 1.24. So there's the right here at 2 p.m. That's the Fed announcement. So there was an initial drop and a spike up, and that's commonly the case. This is what I call post FOMC noise. It usually lasts always through that first day, because that's only a couple hours left in the trading day, and then the next day or two is still in the wake of the FOMC decision. Plus, we had the ECB today as well. That was this morning, and that gave that spike up in the euro, which then, because of the correlation, also brought the stock market up. I'm going to get to that in 1 second. So we're up. There it is. There's our close today. Up 1% since the Fed announcement. So really, not much. We're not down, but we're not up. We're I'm sorry. We're up. We're up only 1%. And the same thing on QQQ. I think it's roughly that. Maybe a little bit more overall since then. 1.6%. And then you look at those commodities I just mentioned here. I got to move them over to another window so they don't keep going away every time I click. UNG, and so again, you can't make a trend, but I'm going to get to that. I'm going to speak to that in a second. There's a point I'm doing this. 9% since the Fed announcement. Wheat, 4.72, we'll round that up to 5% since the Fed announcement. Corn, closed up today 4% since the Fed announcement. Soybeans since the Fed announcement. These are the grains, and that's where I'm favoring in the ag arena right now. I told you that. Those are my favorites. 3.3. All right, you got it. DJP, broad-based commodity ETF, up 2.8. So up nearly, what is that, twice the S&P 500. So obviously you're seeing more money, more buying pressure going into commodities. And from the fundamental perspective, I think, as I said earlier, the case can be made that, okay, so the Fed is finished, maybe temporarily, maybe permanently. Market still thinks they're going to cut rates this year, even despite what Powell's, if you listen to his press conference, he's adamant he's not. Powell's an idiot. Powell never knows what he's going to do. He always gets it wrong. The Fed, in general, for years have been the worst forecasters. Their predictions never come. They pull 180s and they always do it late. So the market's given up on trying to, he's lost all credibility. So the Fed will do it. I'm not saying they're not going to raise. I'm just saying right now, wait to see what happens. I wouldn't put any, if he thought they had to raise again, he was so adamant, he would have given us another quarter point. So, and he didn't. So that's that. He's a dove by nature. It's the old scorpion and frog thing. And he's definitely the scorpion. He's been out of his skin for the last year. Probably kept him up at night having to raise rates, but he was so wrong on that inflation trade. Crude oil up 3%, and that's it. Those are the commodities. So let's get into the relationships now. Let's look at DJP. Let's go over to this board right here, and we're going to look at, let's compare it to the stock market. Edit chart properties, and let's look at the stock market here in green. So DJP in white is your commodity. Again, my opinion, one of the best measures of the commodities arena. And they had a very high correlation. Remember, commodities ended a vicious, one of the longest and strongest bear markets in commodities. It peaked in 2008. So since 2008, commodities have been in a bear market that ended when the stock market bottomed in March of 2000 with COVID. And then they started that runaway ripping uptrend. You can see it there, both bottoming together, and then just measured out. I have DJP in white, so that was a 162% return, and this was at all along Powell just being dismissive and wrong, the Fed saying, oh, it's just transitory, and finally when they just didn't, he couldn't say that with a straight face anymore, and that's where they pulled a 180. They started raising rates back here in 2020. But what I'm showing you there, so you had a positive correlation. And there are times, at least many points in time actually, and at least in the recent in recent decades, commodities generally move up and down with the stock market because they go up and down with economic growth. It only makes sense, right? If there's if the economy's growing, the stock market's going up, and there's going to be a higher demand for copper and lead and aluminum and and other timber and things like that, because there's a lot of building and construction going on and all that. So, however, there are times where it's just complete inverse. So what I'm trying to get at here is go off the current relationship. And if you ask anybody what's probably the single most important thing right now in the stock market to watch, keep an eye on, or what's going to determine where we go from here, I don't think you're going to find anybody that's going to argue it's going to be its interest rates and or inflation. That's one and the same. If inflation comes back and rears its ugly head again, the Fed will have no choice but to cut rates unless there's a huge financial crisis. That's the only caveat that would get them to not raise rates. They'll be in a big pickle if that happens. So let me illustrate here. We start back in the bear market really kicked off officially for the NASDAQ. It was really a double top. It peaked in November, but then again, almost an equal top in January, and that's when the S&P peaked. You can see it right here. Again, the S&P is in green. So what happened is at that point, the stock market began to finally get the memo. Hey, this rally in commodities, the huge increase in home prices, labor costs. We have inflation surging. Sooner or later, the Fed is going to have to take away the punch bowl, the zero interest rates, free money, and all that. And so the stock market started to finally recognize that before Powell did, got the message, and you can see it started to correct. So at that point going on, here's where I'm going. Ever since the bear market started, that's where it became very sensitive to inflation. And again, the best real-time indicator, the only real-time indicator that I know of inflation is this, because it prices day by day, minute by minute, second by second, tick by tick. You can see what this basket of commodities is doing. Home prices, you cannot. You can guess, you can wait for the monthly or quarterly numbers to come in that are a month old, stale by the time they're reported. Same thing with wage data, labor. They do those reports every so often, but they're dated and they only come out periodically. So, this is a way to get a real-time handle on inflation. Not all inclusive, because yes, then, housing and wages and all that also go in the CPI, but this is a big one. Okay, so we got that determined, and you can see clearly the stock market going down, and then you had an abatement. First decent correction in commodities, stock market rallied. I'm sorry, yeah, it did, rallied right here. Now, commodities continued their charge. Stock market really didn't like that. Commodities peaked right here, right after that, the stock market peaked. And it was after that, if you draw a straight line up, you can see that commodities started their biggest correction. And it was about a third, that looks about a third of the way in, almost halfway in. It became apparent that this wasn't just another blip. These are blips. These are corrections in an ongoing uptrend. There's a correction. And so once it became apparent to the masses, it took a little while. Right here when commodities topped, and that was a pretty good drop. And then at this point, markets started seeing, guess what? It's working. Fed just started cutting rates, and they're seeing commodities fall. The market rallied. Yay, here we go. Bear market rally. We traded it. We were long through that, most of that. But then, shortly after the rally got started, but well after the big drop, and the market saw that, you can see commodities started to rally again. And again, there is a lag time because there's a lot of zigs and zags. So what is important? This is the message I'm trying to convey. It's not these little zigs and zags. In any trend, uptrend or downtrend, you're going to have the little, what I call micro squiggles. It is when they become apparent to the majority of market participants that are trading the stock market, that it is anything more than that. That's when the market rallies. So you had another big drop. Once you got that big up, then the market took another big leg down to the lows right there. Then you had a rally in commodities, but it got faded. So pretty much really from it seems to me about this point when the market bottomed, if you look at the white line, which is again commodities, it became pretty clear because at this point you were starting to make a series of lower lows, especially right there. You had lower lows and lower highs. So it became pretty clear to the market that commodities were now in a downtrend, and effectively that Powell's rate cuts have done their job. They put the brakes on the commodities inflation trade, at least this aspect of it. And since then you can see that we've continued down. Now there is this disparity recently. This is another uptick, right? We had an uptick here, told you, and the market was rallying and it kind of shrugged it off. It kind of took note, but then whoosh, another abatement, new low, or at least 52-week low in commodities. And now we have this. So this is my interpretation of this. This is the market looking at commodities in a downtrend, pretty much assuming that the Fed, what is it? What was that stupid line from Bush in the Iraq? Mission accomplished kind of thing. He didn't say it, but that's kind of okay. I'm pausing now, and I think that's the market's take is that okay, he beat back, he won. Inflation trade's dead. He put a knife in it. It's over. Okay, so. All right, well, Randy, how do you know that's not just another squiggle and we're not going to do that? That's the whole point of this video. Glad you asked. Great question. DJP. Okay, I've been covering this chart quite a bit. Number one, as I've showed you recently, made the case through many metrics in the past, long-term charts, everything else, that this was most likely a major bottom, the end of a bull market, the beginning of a new, the end of a bear market, the beginning of a new bull market in commodities. Only time will tell. You can have your opinion. I have mine. Well, time will tell one of us right or wrong down the road. But so far, this pullback in commodities is just it's indicative of corrective action. It's a 50% Fibonacci retracement, a run-in-the-mill counter trend pullback in a longer-term uptrend. So that's my view. When does that start to change? You go down below the 60% fib, you start taking out other things, and yeah, that case can be made. So based on that, and that's not only it, you also have, of course, as I've been pointing out for a while, the big divergence. Here, let me turn off the lines. I'll just draw the same lines that are on this chart, but it'll be a little more clear if I do it this way. So there's that positive divergence that's been building. It almost mirrors the negative divergence on the stock market. And so, if this one plays out, then obviously that's a big divergent low. And it would indicate not just another blip, but a much larger trend. That coupled with the downtrend line you can see here, which again, I'll draw it out for you. That was taken out today. Now, not by a large margin. We had one little tiny whipsaw right there. Only one violation of this trend line, but there's a lot of reactions. You can count them. There's probably over a dozen reactions on that trend line. So this is the pattern we're looking at. And so my point is, right now, today, we had breakouts. We had breakouts in DJP. A few days ago, I highlighted crude as looking bullish for the first time in a long time with positive divergence on the 60-minute chart. I said for months, I've kind of just backed off crude, no trades long or short because it was in a sloppy trading range. I'm not crazy about it, but I did like it enough to point it out and take a position the other day. Natural gas, I've been pointing that one out for a while, and we're going to look at it again here. So that's that. And, in DJP, again, nothing goes up forever, just like you have this divergent low here. You had a divergent high there at the top, and that's what gave us that correction. So that's it. So there, when you zoom in nice and tight, you can see the breakout. Again, you had one little whipsaw there, but this was a big green candle. And then when you look at the things that matter too, or carry a big weighting, you have USO. It was the crude futures I showed you the other day. I don't have that chart queued up. It was a 60-minute chart. Yeah, no problem. I can just pause the video and queue it up, which I did. This is the pattern I showed you. Again, first time in a while I've seen nice, clean, positive, aka bullish divergence on the 60-minute chart, and a nice, very steep downtrend line, a breakout right there. And since then, crude's rallied 5%. So you're coming up on downtrend line resistance, price resistance. Again, not a screaming buy, but certainly attractive, worth a shot. Stops at this point. You can see it starting to make the very early makings of an uptrend. Higher highs, higher lows. You can put a stop somewhat below that previous reaction low or below that low. Up to you if you want to take it or if you're in it. Okay, here's my long-term chart. This is a weekly chart, meaning weekly candles. We're going back to 05 here. So it's a long-term chart on WTIC, which is crude futures, West Texas Intermediate, like crude oil. Old lines I haven't touched. This is a line I've had. I'm not crazy about this, but I've had this line, all these dashed vertical, horizontal support and resistance lines for a while, and this is a pretty good one. Going back, let's just go back to this point here. It was, resistance right here. We had a false breakout above it. And then, bearish rising wedge, which we broke down, got a sell signal on it, and then dropped down there. Rejected. Finally broke it out. Successful back test 1, 2, and then rallied. And now we're back down to it. So it's a decent support level. I don't even want to rank it on a scale 1 to 10, probably a 7 or an 8, somewhere in there, maybe 7-ish, but decent. Positive divergence, that's something I look for on bottoms. And so again, I can make a decent case. I'm not crazy about the downtrend line here, but it's there, and there's that divergence. And so it looks like a breakout and a back test. So, crude has the potential to rally here. And if it does, again, the takeaway is if you continue to see it start to rally, start to take out resistance levels, natural gas, especially the other commodities as well, welcome to the return of the inflation trade. And again, is the market going to correct on one day of crude oil or natural gas going up? No. 2 days? No. But after a while, several days, several weeks start to make a trend, especially more so in percentage terms. And then I think the market will get the memo. So we're going to, anyways, let's move on. I just want to show you from a different perspective here that crude is at support, positive divergence. So again, the case was made the other day, but I think you could still make the case to step in there. And that's what it looked like on USO, the one of the more popular ETNs for crude oil, 60-minute chart, of course. See, daily is still kind of meh. Yeah, there's that same downtrend line I just showed you on my WTIC chart here. Comes off the high. It was fairly well defined. You had a false little failed breakout there, and we're kind of on it. But it's been sloppy. Crude's been sloppy
Market
lately.
data connection lost.
Oh, and I didn't even realize this till I'm looking right now. Way back here, I pointed out we had a divergent high. We shorted crude. I gave you a final swing target of 58.60 in this uptrend line right here. Well, it took a while to play out. We did hit the uptrend line, and then we hit it again, we hit it again, we hit it again, then we broke it, and then we went on to hit. See, when I do that at the time, it's when I'm projecting a move to come down and hit those together. But it was still my maximum final target, and we hit it to the button. And I did point that out a few weeks back, and we traded crude long on that. So where am I going with that? Well, quite often, and that was and is my maximum, final pullback target, and that also completes, pretty much to me the corrective wave that was priced in, with crude going crazy, getting real high, overbought, divergences. Yes, those things still matter. No, they don't always play out, but more often than not, they ultimately do. Okay, so I've established we have what appears to be a breakout in DJP following a divergent low. And, if we continue to build on this, all the better. If it fails, and maybe this bear trend in commodities continues. And overall, net, this should be bullish for equities. This should be bearish because the more we go up, the more it will force Powell's hand to actually go through with his I don't call it threat, whatever you want to call it, plans to continue raising rates after this so-called pause he just did. So that's something to watch, but the breakout's in play. And so that was my point, guys, when I was back here a minute ago saying, okay, so the market right now, stock market in green, is ignoring this blip. What makes this blip different is what I just showed you there. I just showed you breakouts. I showed you crude, DJP as a whole, crude oil. I just showed you the breakout. UNG. And just like the stock market, been pointing out this divergent low and this divergent. We've been diverging for a while, but it only gets bigger and bigger. And these big divergences, just like this one, just like up here, we shorted it, pointed it out. We shorted this one, trades were hit. The bigger the divergence gets, typically the bigger the drop. So we had a pretty big divergent high there, a pretty healthy correction. And what happened? We rallied back up, made a marginal new high, but still an extension of those previous divergences. And then all this came. Now we have an equally as powerful divergent low, positive divergence. And, soon we'll be heading into seasonality for natural gas as well. But, in this market, again, from a fundamental, my hunch is you're going to start seeing institutional smart money starting to move into commodities right now because the risk reward on equities, in my opinion, is abysmal. I don't care how strong the trend is. The risk reward, the upside potential compared to the downside loss is ugly from both a fundamental and technical perspective. So probably see, and again, you're starting to see, look at the volume bar on UNG today. And, you can look at natural gas futures too. T1, I've moved these targets up for you. There's the resistance. Look, to buy it today, this is my first target here. This is pretty good resistance. It's also this basing pattern. However, if and when that breaks out, which based on the divergences, it looks like it will sooner or later, it's going to be pretty powerful. And I will most likely list additional targets. But right now, let's just leave it at that T3 at about 891, which if hit gets about another 27% upside. Okay, so we've seen. I don't know if you want to call this a breakout per se. Maybe on the shorter term time frame, but bullish price action nonetheless. And again, it contributes to that whole basket of commodities. The other ones that I've highlighted, and this one was actually thrown out as a trade idea a couple weeks ago, made a marginal new low, but still within any decent RR for keep it long. In other words, wouldn't have been stopped out. And big divergence again. So this is a common theme, and I don't want to sound like a broken record, but these are what you want to look at. You want as much evidence as you can. So you have large positive divergence. Yeah, you had a divergent low there. It started to play out, but you hit the trend line. You hit price resistance, and you kept the downtrend going. So it's just a bigger divergence than it was back then. And now, again, on my theme of what's different. Why am I doing this now? What's different about this little uptick that the stock market is ignoring? Well, you just had wheat breakout. And wheat is one of the big grains. Wheat, corn, and soybeans are your big three. So there's a clear breakout in wheat, and high volume, impulsive. Yeah, you have some resistance there. You have resistance there, which can be used as price targets in there. But it's very possible when you go long term. You look at this is a long term chart. This may be, if I'm correct, and this was the end of a great big bear market in commodities, including wheat. This was just a big old. You can see very, very good support here. 596 on WAT, which is the wheat ETN. It was support, broke that support. Support once broken becomes resistance, breakout. Resistance once broken becomes support, back test. And boom, we fell down to that level. PPO is actually not just poised, just made a bullish crossover, but I stand corrected. This is a weekly chart. All that matters is 4 p.m. tomorrow. So if we can hold or build on these gains, that'll be the first bullish PPO crossover since this one, given that one resulted in a whipsaw. You've had a couple whipsaws, but I look for these are your trends, these big green and red hills, and you had a breakout right there. And you can go back and see trend changes usually occur. Look for these red and green hills, and those are your little kind of trend changes on the PPO. So there's wheat. Corn looks similar, although corn is coming up to a pretty big resistance level, downtrend line. PPO made a bullish cross. Again, this needs to be finalized tomorrow, Friday at 4 p.m. because I'm on a weekly time frame. Here's what corn looks like on the daily. You have a downtrend line right here. It's coming up on. Just put in a divergent low. You have divergence at this point, but also bigger divergence that goes back just like wheat all the way back into spanning about a year or so. And so that's the outlook. And so if that breaks out, bottom line is, yeah, we're coming up on resistance, but if it breaks out, we could get the next leg up in ag commodities. And then soybeans, they've been ripping lately too. They did just break out today. Downtrend line was taken out impulsively, and you had divergence here, down here on the RSI. Okay, so that's it. Take them either as trade ideas or just something to watch. I get very little feedback for some reason. As I say, all the feedback tends to come on the equity markets, very little on, even lately. Nobody wants anything to do with it. I get it too. Most people don't. I know most people don't short, even on this site. A lot of people only want to buy things long. And so, a lot of times if I'm going long Bitcoin, everyone wants to be on it, and I don't want to short it, at the highs. But that's, so these commodities are long trade ideas, but they're also, again, even if you're not taking them, and I'm a big proponent of diversifying, different asset classes possible, different sectors within your equity markets, and long and short, it's being diversified, long certain most bullish equities, and short the most bearish. So we'll watch this trend. Again, there has been some predictive value because it's after commodities peak. Then there's a lag time, and once the market becomes apparent, that's when the stock market has rallied. all these bull market rallies have started. And then likewise, if we continue to build on these gains in commodities, the stock market will get the memo and it will say, uh-oh, you know what? Powell maybe isn't finished. Maybe inflation's coming back, and it is a problem. And that's where, if and when that happens. And again, there's not a single threshold. It's more of an incremental thing. But, from the look of this, it's usually not that long. It's, let's just say we go up another, I don't know, maybe even 4 or 5%. We'll see. All right, the other thing I wanted to show you, and we'll wrap this video up, is the relationship between the stock market and the dollar and or euro. Again, euro is just looking at the dollar upside down. I can show you a couple other vehicles like UDN, which is a short dollar ETF, short dollar index ETF, or UUP is a bullish one. But let's start out here. So here's a chart I got out to you today, and I've been covering this lately. We had the breakdown here, break of both the bearish rising wedge and the price support. To me, a pretty significant price level, about give or take 109.4 or so, and that's so far we rallied right into it, and that's where we stopped. So as I said earlier today, my expectation is for a pullback. This drop was foreshadowed and predicted by that breakdown there, and I thought it might be over, and even went long silver in the metals because of that recently. However, a couple things. Number one is gold. Gold did not react today. Gold closed flat on the day, and we had one of the biggest. Currencies don't move that much. Look at the size of that candle. That was a huge rally in the euro. Again, odd to me because it was priced in already, expected. But whatever, it is what it is. Anyways, they rallied into resistance. So I can't promise you where we go. I promise you I think it's an important level to watch. And I think we're going to reject, as I told you, and go down here. I'm looking at right there. That was the measured target, the purple line, but I'm really eyeing this 105 here. I'll color it up for you right now. So if we do reverse, this is a level I'd be looking at, about 105.3 right there, because that's nice support along here, and it's a little shy of that measured target, so, or called a target zone, 105.3 to 104.7 down there. Okay, there's 57.6. That's the weighting of the euro and the dollar index. And then the yen is like 23 something. And then everything else doesn't even move the needle. When you add up the euro and the yen, that's almost the entire dollar index. So that's why I watch that. This is what it looks like on a weekly chart. So on a weekly chart of the euro, you can see there is that wedge, bearish rising wedge, negative divergence here on the histogram. Let me park the histogram. I'm done using that for now. Divergence on the RSI. And again, we broke down. We had a wave down. And sometimes that's all you get, but it's a little atypical. Typically, corrective waves, even if we're going higher, which I do believe. My long-term analysis, I've been bullish on the euro, bearish on the dollar. This is a primary downtrend line I think we're ultimately going to come to some point in the coming months to years, but as of now, we're looking out today, tomorrow, next week. Not I'm not looking out 12 months from now. So this is a initial wave down, and what appears to be a counter turn ABC. So an ABC corrective wave would take us down there to that target, and then that correction would be over. And so now I've given you my outlook on the euro, which, by the way, UUP, as I said, is the dollar index ETF. And then UDN is the inverse. It flips the dollar upside down, and that's what that looks like here. I'll show you. I have a daily. So UDN is going to move in line with what I just showed you with the euro. One and the same. It's because it's the backwards dollar, inverse dollar. And so you can make the same case here. You had negative divergence, this little wedge pattern right here. You had the sell signal recently that took us down there. You hit the uptrend line, you bounced, and you're also at resistance. That's $18.98 it says. We'll call that $19. You have a nice major reaction high there. Definitely one there. And then you went above it briefly and failed that breakout, and you did it with negative divergence. So, if we go down and then we break the trend line, that's going to also take us down to, this is my target there, 18.18 and UDN if you wanted to. If you don't have a Forex account, don't trade Forex. you got to put a lot of money in, so I don't even mess with these, if I'm going to trade, I'll trade futures, either DX dollar futures or E7 euro futures. You get the leverage in there because currencies move so little in percentage terms. You're going to have to load leverage up to make it worth your while. I'll tell you what I'm talking about here. So let's just say my target's hit. The dollar drops, rallies, I'm sorry, because this is inverse. UDN drops. That's a 4% move. So that's why you don't, it's not, you can make, put enough money in there, it's worth your while. But I'm more so sharing this for the outlook in the market. So we go back now to the comparison. Again, where I am most interested on when this bear market started, which is right here. There's January 2022. And you can see, I can look at UDN. You can already see the correlation. You can use FXE for if you don't trade or have EUR USD, Euro. They're all the same. So, and what they're showing you here is the unmistakable correlation, again, which is meaning the euro goes up, the stock market goes up. The euro goes down, the stock market goes down. Or that's the same as saying the dollar goes down, the market goes up, because the dollar's inverse. And so, it's hard to argue this correlation. You can see here, they've been working in almost perfect lockstep. And don't look at, you have a differential in price here, but look at with the trends, they're both rising. The stock market, that's the euro and white. I'm sorry, euros in white, the stock market's in green. And you can see here, they both bottomed. That's where the stock market bottomed in October. But look at that, the euro bottomed and the dollar topped just before, back in September. So there's a little bit, quite often, not always, there was a concurrent inflection point there. But quite often there's a little turn. You can see really the bottom in the euro and then the market bottom. So there is can be a little bit of heads up. Okay, sorry, I had to pause the video there. A little frog in my throat, and then I went to get a drink and took a phone call. So where I was at is let's see there. Oh yeah, there seems to be at times a little bit kind of a heads up where the currencies turn first. But more importantly, that's not always the case. And again, a little blip isn't always a trend change. Trend changes are only clearly visible in hindsight, right? The big moves, the inflection points. I'm talking about these. This is an inflection point in both. There's an inflection point. Well, that's the thing. There's been a divergence lately where there was this drop in the stock market, ignored it. You can see the S&P going up completely. And so far, there's been a mean reversion. So the euro, and most of it happened today with the hike from the ECB. So it's following the S&P up. Now, that goes back to what I was talking about. So it's all about being right or wrong. If I'm right, and this level does cap this advance, and again, if they did a surprise quarter point hike, that might be a different story. Again, I'm a little bit surprised to see it rally this much on what was baked in. But again, I don't know. I didn't listen to the statement. Maybe there was something else in there they talked about. So that's it, guys. If we blast through here, then maybe this is all we get as far as the correction from that wedge breakdown. And maybe we do head up here. If you remember, back here as we're wedging up, I thought that wedge, the euro might make it up to that point. And it reversed a little shy. So that would be a possibility. And let me try to explain what I think will happen. If that happens and we go up, it's not a whole lot, but it's a decent move for the euro. Then it's most likely going to be near-term bullish for the stock market and near-term bullish for gold and silver, which again did not participate today. They certainly came off their lows. It was this morning when the rate hike came out, the ECB, and gold and silver were down pretty heavy at that point, and then they rallied. So I don't know. I only scanned the headlines. Maybe it wasn't widely expected, which was what I read. All right, so that would has the potential to give us another thrust up in the market, another thrust up in the metals, and then put in still possibly another divergent high there. But let's see where we go with this. Okay, so in summary, this is as good a place, and it appears to me to be the more likely scenario. Not a screaming sell signal or a screaming short, but if if that's the case and we reverse and start moving down lower, especially if we come on down this far, based on what I just spent good 30 minutes or more talking to you and showing you the unmistakable correlation between the stock market and the euro. So there's that, and that would favor market down. This would favor market up, and also the correlation between commodities and the stock market. So monitor that as well. Any more upside in commodities, especially those that move the needle the most, i.e., energy. That also plays into that XLE short. That should be, I think, closed out at this point. That's what I did the other. Remember, we had a long-standing short on XLE. T1 hit here, T2, T3. These are the next two targets. This has been good support, but to be bullish on crude oil and natural gas is to be bullish on the energy stocks. And I'm be honest with you, I'm surprised they didn't do. They haven't rallied any more. They look poised to break out here, and again, that will most likely happen if crude continues much higher. The energy stocks will get the memo. So if you want another trade idea for you, XLE, maybe if you haven't already covered that short at T3, you had plenty of opportunities. Consider at least lowering your stops. XOP, you usually get more bang for your buck in XOP. It's another ETF in the energy sector, but it holds the exploration and production companies. And it's recently broken out, but it's not taking volume yet. Remember like that Beyond Meat trade, it broke out and it said, okay, you can take a breakout, but you want to take a partial position and then add to a full position when you start to see the volume coming in. So at this point, you can see if you zoom in real close here, you have a couple reaction highs right here, 129.60ish. Pop above there should do the trick, and that should bring the buyers into XOP. You can use Gush, or I don't know if Gush and Drip are, Gush is just the leveraged version of it. Drip was the short. I don't know if they eliminated that one. And then if you want even more bang for your buck on a non-leveraged XES. So in that order, that's how they usually go up. So when I'm bullish the energy sector, XES, which we're looking at here, holds the equipment and services companies. This is kind of my GDX to gold. In other words, you're going to get much more bang for your buck. If you're right on the call on gold, it goes up 10%. The miners, which are GDX, probably going to go up 20 or so. So this one tends to have the highest beta, the most volatility, and that cuts both ways. And it's already actually broken out, back tested, and it's been moving higher. And that's usually the case, coming off a big divergent low. These are my targets right here. Minimum first and next target, $80 right there. So there's still some meat on that bone. It's already about halfway there. And then of course you had XOP and XLE is more the steady eddy. And I always say know your ETFs. XLE, unless anything's changed in recent years, is pretty much you're just trading two stocks. It's I haven't done these. I haven't updated this since the end of 2022, but it's this ETF is very top heavy, just like the NASDAQ 100. So it's not representative in the entire energy sector because about almost a quarter of that, 23% is Exxon, and then 20% is Chevron. So right there, half of that ETF, pretty much, or almost half, is literally just from two stocks. So keep that in mind now. So obviously you look at those charts, you could trade those stocks themselves or just buy the ETF. Might as well, you get the benefit of diversification in there. Okay, that's it. Let's pick this up tomorrow. The post central bank, it's not even just FOMC, it's the ECB as well. That post central bank dust should be settling out into tomorrow. I believe somebody mentioned we have is OPEC's coming up this it would be next week. Either way, we have Friday coming up and then the weekend. So let's see. Let's pick it up tomorrow. See what happens with the euro. Like I said, I'm thinking we're going to get a rejection here, and then that should take us down. And where I started the day today, no sell signals yet, or at least not the next sell signals. You have the uptrend line and SPY on the 60-minute chart, not yet violated. Came back tested this morning, bounced off that, and the same in QQQ 60-minute chart. That uptrend line still, that was an intra-period spike back above it. So you still have these 60-minute divergences and trend lines that need to be taken out. And then again, as I did earlier today, much more importantly, those big fangs: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Tesla and Meta gave you key support levels, and you want to see at least two or three of those break to start building anything decent on the short side. But then watch everything collectively. Watch the euro, like I said, watch commodities, and then the indexes, and then these market leaders. They're all intertwined, and they all have that those relationships that I just showed you earlier. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.